Well, hello and a very warm welcome to this Structured Finance Activity Highlights webinar brought to you by Scope Ratings. My name is Keith Mullin and it's my pleasure to be your moderator. Now, we've structured today's session into four short segments. We'll kick off with a summary of the main takeaways from Scope's new rating and monitoring activity. We'll move on to discuss the findings of some research we've conducted on a critical market theme: how to integrate climate risk into structured finance using Scope's macroeconomic climate stress test tool. Today's focus will be on CLOs. We also wanted to present some afterthoughts on IMN's recent Global ABS conference in Barcelona. Scope analysts took part in two formal conference sessions, and the Scope contingent conducted close to 100 meetings over the course of the event. So what were the main talking points? And then we'll share our thoughts about commercial real estate and CMBS, as well as Italian non-performing loan ABS, both very topical themes, and subjects on which we've actually conducted separate webinar sessions, and we'll be happy to share the links to those sessions after today's discussion. Now, following the four segments, we'll be very happy to take your questions, so please do type these into the Q&A box on the platform. So that's it from me. Let me introduce you to the analysts on today's call from Scope Structured Finance and ESG teams. So please welcome Florent Albert, Shashank Thakur, Stefano Bracchi, and Arne Plateau. So hi guys, great to see you all. So let's get straight to it. Shashank, let me hand the floor over to you.
Thanks a lot, Keith. Thanks for introducing us. So welcome everyone again to this webinar hosted by our team. So first theme for today would be our ratings activity. So I would like to walk you through on a very high level on what we have been doing in past few years in our team in terms of the rating activities and what our current stock of the monitorings. So as you see here on the top, figure number one. So the main takeaway of this chart is basically we can see over time how our new ratings have evolved over time. So currently you can see that the total new issuance that we have rated so far, including the public and private space, it stands around 235 billion euro equivalent. And the important thing to note here is that the growth has been quite consistent in past few years, and we can see in this orange line, which is we can see on the right hand side axis, the growth has year on year growth has become quite stable over last few quarters and currently stands around 14% year on year. So one of the interesting thing is, in given that we are talking about the most recent quarter, so this was just an overview of on how the things evolved in few years. So and in terms of the new instruments that we have rated over time, I mean it has moved a bit in terms of what were the asset classes that we have worked on. So it depends really on the market scenarios, on how our new ratings that we work on evolves over time. So for example, if you look at figure number two, what we are highlighting here is the activities in last 4 quarters. So if you draw your attention towards the new ratings that we did in last 4 quarters, and specifically as you see in figure number two, we have variety of asset classes. So, but it is also important to note that we have been more active in, as you can see in the big bars in the blue color, in the CRE CMB space, and also in other type of asset class which are non-standard. So if you look in number terms, we have been working on around more than 100 new instruments in the last year, and these other asset classes that you see in the blue color were mainly concentrated in the private segment. So basically, we were working mainly with the repackaged debt transactions. These are basically the repackaged sovereign bonds or corporate bonds with the help of a swap. Generally facilitating the needs of investor in different ways. And there have been other asset classes which were a part of the others, but mainly was this repackaged debt transactions. And with the in I mean in a cumulative sense, our portfolio of rated instruments is mainly weighted by CRE basis NPLs, and mainly Italian NPLs. But you see that our recent activity in past 4 quarter has been quite modest in NPLs after the GEC scheme ended in Italy. So I would like to now move more towards our monitored ratings. And here we will just like to highlight only few things, mainly in terms of how our monitor ratings or monitoring ratings, I'm sorry, monitor ratings has moved over time. Uh, in the chart on the top we can see so let me define what we are looking at first. So what we want to show here is the rating drifts, and how we defined is just a relative moment of the upgrades and downgrades of our monitor transactions of our monitor instruments. So basically it's just a ratio of upgrades versus downgrade in relation to the total stock of our monitor ratings. So we can see on the top chart how this ratings have moved. So basically, this rating drifts is inclusive of all the instruments that we have rated. So includes all the asset classes, NPL, CRE, CMBS, and everything. So we can see some interesting points in the straight blue line that we see. So on the right hand side is the way to read it. So we see like as the corona started in 2020, we see that there was more weightage in the downgrades, and as soon as the economies start to rebound in late 2021, so the rating drift again started to become positive. But we can also see that in the recent quarters it has again started to go in a negative direction. uh, but by nature, just one thing to add as well here in the top chart is that by nature, as the instrument life goes towards maturity, so they are bound to move to the extreme. So we can still see this trajectory going back in sort of a upwards trend. And one of the last point to highlight, which is of an interest given the stress macroeconomic scenario with the rising interest rate environment and energy crisis in jurisdictions, especially like UK and also Italy, where most of our rated instrument jurisdiction lies. So we'd also like to highlight two specific asset classes that we would like to show what's really the reason of this downtrend of the rating drifts. So one of the reasons being uh, less than like worse than expected performance of the assets in the NPLs, which we can see in the chart on the bottom left. So NPLs and CRE and CMBS sectors segments were the two which are dragging down this rating drift in the negative direction. And in this CRE, the mainly the reason for the downgrade was due to the lot of refinancing risk in this segment, and for NPLs it was mainly, as I said, due to poorer than expected asset performances. So with that, I mean, there are pretty more things we could discuss, but on a high level, this is basically the state of our current rating activities in the last quarter. So with that, I would like to move to the next theme of our webinar. So Arne, would you like to continue from here?
Yes, of course. Thank you, Shashank. So I want to have a few minutes to talk about a research we published in June, where we had a look at the impact of climate risk on CLO ratings. And to start with this analysis, it is necessary to understand a bit Scope's macroeconomic climate stress test model. And this is a macroeconometric approach. It is based on the country sector value chain data coming from the OECD input-output tables, which we project along three different scenario is coming from the NGFS, an orderly scenario where timely climate action is taken and as a consequence has a relatively low physical risk. And disorderly scenario with climate action taken, but only later and more chaotic, and as such also higher physical risk. And a hothouse scenario where no climate action is taken at all, and as a consequence has the highest physical risk in our scenarios. And on top of the NGFS trajectories, we model our own climate risk indicators, and those consist of 3 parts. There's a chronic physical risk part, which consists of permanent temperature increases in the countries under study. There is an acute component, which is caused by an increase in extreme weather events such as floods or droughts. And there is a transition component, which is caused by increases in carbon taxation. The output of this is an expected output gap for each year in the period 2020-2050 due to the aforementioned risks. So you may wonder what this has to do with CLOs. And before getting into that, maybe as a little reminder, an output gap, what it means is it is a percentage difference between an actual output and a potential output. So that means that if you have a negative output gap, you're actually producing less than what you could be producing. So with that in mind, we can have a look at the slide where you see a number of scatter plots on the x-axis the output gaps and on the y-axis the bankruptcy rates. And as you can see, this relation is negative. So in times of negative output gaps, we would typically observe high bankruptcy rates. The relationship is depending on the country, and in particular in the Scandinavian countries, Finland and Sweden, it seems to be rather strong. The relationship is also not necessarily stable over time, and what we found is that it in particular tends to become more intense in times where large negative output gaps are occurring. So we have this relation, and we calibrated this on historical data on both bankruptcy rates and output gaps. And this presents us with a link between the outputs of our climate stress tests, as I showed in the previous slide, and bankruptcy rates, which we can then use in the analysis of CLOs. So I want to present you some results. And on the left-hand side, you can see a number of cumulative default probability curves for a number of SME pools in France, Italy, and Spain, respectively, for the 3 scenarios of our climate stress test: the orderly, the disorderly, and the hothouse scenario. And we see and you see the black line, which is the normal default curve if in a case that no climate change would be happening. And on top of that, we then have the different components of our climate stress test. We translate this in a notch impact on the right-hand side for the same pools and for the same maturities. These are average curves, so they might be different for specific pools, and that depends on the sectoral makeup of that pool. So what can we learn from this? And there is a few points I would like to highlight. First is that in all scenarios, some climate losses will occur. If it comes not from physical risk, then from transition risk. We see that over the different countries, there is quite some heterogeneity. And of the 3 countries we consider here, the French SME pools have significantly lower risk than the Spanish and Italian counterparts. The impact is also depending on the time horizon, and in particular, the latter period is becoming more heavily affected. This is because most of the losses in our climate stress test are occurring towards the end of the period. In the short term, the impact is moderate and would amount to about 1 notch. But as I mentioned before, this impact grows with maturity. And even though that these maturities may seem long, we still find it relevant given that investors remain exposed to refinancing risk. So that is, in a nutshell, the study. And with that, I would hand over to you, Florent.
Thank you. Good afternoon, everyone. I'm going to present you firstly a recap of global ABS. So global ABS is the largest securitization for ABS and mortgage-backed securities conference in Europe with more than 5,000 participants. It was in June, end of mid-June in Barcelona, and some of the key takeaways are presented here. First, at the macro level, the optimisms of the participants was generally on the cautious side for two main reasons. One is on the negative side, the end of the ECB ABS program that you can see on the top right-hand chart. But this was relatively positive for most of the participants because they see that as an opportunity for bank issuers to reconsider the usage of securitization as a low-cost alternative funding source. The second one was the emergence of non-bank issuers that are playing a growing or an increasing role in the securitization space because the usage of securitization for them is key in terms of their funding growth strategy. In terms of issuance, instead the second chart on the bottom, this is, I would say, until June, resilient in the sense that it was aligned with issuances in 2019, better than 2020, but lower than the recent years, despite an era of low interest rates, volatile spreads, and sideways trading. In terms of the supportive asset classes, RMBS has seen a lot of issuance, while CLO was slightly under previous years, and for example, the CMBS market has not seen any issuance since the beginning of the year. It's also important to notice a growth of private issuances, with bank making a larger usage of synthetic balance sheet securitizations and the emergence of private credit and subscription line business. So you may have noticed on the first slide presented by Shashank that in scope, a lot of the new activity over the last quarters have been on the private space. Finally, in terms of collateral performance, there's a resilience so far, both in terms of asset performance and structure performance and rating resilience. But everyone expects the underperformance to start surging with defaults or these stress periods crystallizing in higher defaults over the next 18 months. And one of the key conclusion was as long as interest rate and inflation don't stabilize, the full impact on some of the asset classes and on the collateral side won't settle. Finally, in terms of the outlook, most of the warnings or worries are around credit cards, ABS, CMBS, and NPLs, while participants believe RMBS, CLOs, and auto ABS may be more resilient based on historic performance. Now, moving to the next slide, which is about a webinar we held a month ago about the real estate environment in Europe. These are a couple of charts that we wanted to highlight. The first one, the two on the top, are basically all the CRE loans that have been securitized in CMBSs in Europe since 2017. And the one on the top left hand is presenting the loan to value levels, while the one on the top right hand present the debt yield levels. What we want to show with this is two things. First, the LTV levels of the loans that have been underwritten over the previous years have been quite sound, 60%, with some outliers, I would say, in the high 60s, 70%, that knowing that most of the assets have been repriced by 10 to 20% nowadays, are pushing some of the loans to really high LTV territories. But the most striking point is likely the debt yield levels of these transactions that with many transactions having DPLs between 6 and 8%, in the current environment, having base rate plus a margin around all-in rate of 7 to 8% according to GBP or Euro will make these loans not refinanceable under the same terms and conditions. And this highlights really well the current tailwinds that the sector is facing. The third chart on the bottom left presents the performance in terms of rental income for all these transactions that have been securitized since 2017, based on classified by asset or property type and how the income has performed since then. What we can see is that the retail sector, with not much of a surprise, has been extremely hit with rental income significantly down, especially for shopping centers and retail. Here, it's mostly shopping centers in the UK and in Italy, and retail in the UK and in Italy, with residential and industrial overall generally overperforming, and then a mix results on other asset classes. The last chart presents the connection or the LTV change versus the DPL change of, again, all these CRE loans. One key element is on the left side, i.e., all the LTVs that have reduced coming from an appreciation of the collateral value due to the yield compression. Interestingly, we see that most of this LTV compression is coming from the spread and not from the income, because the income in terms of debt yield has not shifted positively in a dramatic manner. So this, we expect most of these data points to move towards the right-hand side of the chart as the valuations or the collateral is reassessed. And this will lead us to the outlook, where while we acknowledge and we believe the cash flow generation will continue to remain strong, driven by the inflation and the pricing power of some of these prime assets, some dispersion in terms of performance is expected with market dislocation, especially around on one side the ESG prime assets and versus the, I would say, secondary stranded assets. We already see some cracks with some forced loan maturity extensions or even defaults in some CMBSs or CRE loans securitized in CMBSs. We are hearing and discussing about some banks offloading part of the CMBS or CRE portfolios with synthetic transactions, but we expect more to happen with more discussions around foreclosures, etc. Finally, most of the ratings that have been presented by Shashank, rating downgrade that have been presented by Shashank on the second slide, are related for the real estate sector to low yielding assets, some office, mostly construction loans, and some weak financing structures that are exposed to the current environment, or that the weaknesses are highlighted in the current environment, especially in the German market. With this, I will hand over to Stefano.
Thank you very much, Florent. And I would say that we can move to the next slide, where, as Keith said in his presentation, we had a webinar regarding Italian NPLs in June that was done by two colleagues, Paola Lichtenstein and Rossella Guidoni. Of course, you can watch the full replay which is available on YouTube, and download the report. And now I will give you just some details about the main results and the outlook for Italian NPLs in 2023. I would like to start from this slide, the first slide, which represents the timing, so the comparison between gross and net cumulative collections and the expectation made by servicers at closing through their business plans. The result is that the performance of Italian NPLs has been mixed, in the sense that for 1/2 of the transaction, what we see is that the performance has been below what was projected by servicer in their business plan, and there was a negative delta of around 25%. These one are usually the oldest transaction, while for the other half of the transaction, what we see is that the performance has been better than the business plan, with a positive delta of on average 109%. Let's say that another thing that is worth to say is that there is no substantial difference between gross and net cumulative collection. Gross collection are on the left and net collections are in the right if we compare them to business plans. And regarding the outlook for 2023, what we can say is that we do not imagine to see something different at the end of 2023. And regarding the transactions that are performing below the business plan, we expect to see this delta move from -25% to -30%. And for the transactions that are above the collection expected by servicer, what we expect is that this positive delta of on average 109% will shrink a little bit to approximately 70%. Now we can move to the other slide where we have another chart regarding profitability. This is the scope profitability on close position computed at B case, where B case means at B rating. Indeed, on the horizontal axis, we have the scope B case profitability, and in the vertical axis, we have the percentage of gross book value that is referred to close position. And bear in mind that a position is closed when the servicer does not expect any further collection on that line. Analyzing this scatter plot, what we can see is that around 80% of the Italian public NPL transaction are below the 100% threshold. So the profitability for this transaction is below our expectation at BKs. Again, what we can imagine for the future, what we can forecast is that we won't see a sudden improvement for profitability. Because usually servicers tend to close at first, at the beginning of the transaction life, they tend to close the mostly profitable position, and then as time goes by, as transaction age, they will close also the less profitable position. So we do not imagine to see this profitability to improve in the next future. Keith, I will give you the word.
Okay, thank you very much, Stefano, and thanks everyone for your contributions. Please do type your questions in if you have any for our speakers. But I've got some already, so we'll go straight to those. And the first question is this: what are Scope's expectations for structured finance activity for the rest of the year? Shashank, Florent, do you want to take that one?
I can take that one. Florent, maybe you can add to it. To be fair, I think it's difficult to say in a very specific sense how things could look like for the rest of the years. But I think with how the year has unfolded so far, I think it would be still fair to say in terms of the new issuance, the activity would still be quite modest in terms of what we have been working on in terms of standard asset classes. And in terms of private rating activities, it will also be a bit modest, mainly because the lenders are very cautious in this environment to place the capital with the new financings and with the rising cost of funds as well. And in terms of monitoring, I think again, like also in the private segments, it's going to be more like a regulator asking the lenders to reassess their current financings. And for example, also in NPLs, it's also like a mix of how these structures are for the transaction that we have rated, and how does it interacts with the macroeconomic scenario. So in terms of the rating drift that we saw in the slides that we were looking at earlier, so it would be interesting to see if the conditions stays as they are. So we might even see a positive trend in the rating drift in our mortgage transaction. But if, of course, the situation worsens, then we could also see the status quo.
If I may add to this, and it's also echoing what we heard at Global ABS, is that in terms of asset classes that are, I would say, hot topics and where we see discussions and activity. One is equity release mortgages in the UK especially, about real estate refinancing transaction, but also transaction related to leasehold or ground leases. Direct lending, we see some activity here, and buy now, pay later are probably also some of the key hot topics at the moment for H2.
Okay, very good. Florent, can I stay with you? You briefly touched on your thoughts around commercial real estate loans and CMBS. And this is one of, I guess, the topics du jour in the sort of in the press and amongst investors, is what happens next in CRE. Is there any good news amongst the negative headlines?
This is an interesting question. I think it's true that the headlines in general are really negative, mostly or driven by what's happening in the US, especially in the office market. The conditions in Europe are different, even though there is also pressure on some of the office sector and generally on the real estate sector after 10 years of, I would say, 10 golden years in terms of rate conditions. Now, what we have presented today in terms of income growth is really there for most of these assets that can pass on inflation to their tenants. So we see a rental growth on these assets. We see a lot of liquidity on the sideline, able to step in and to, I would say, take part of the role from banks that are retrenching from some of the sectors and bringing more liquidity. And there are overall there are appetite and a resilient appetite for the asset class as a whole, with many equity sponsors that are happy to take more risk at the moment to invest, having a mid to long-term view.
Before we move on, just very quick, you also mentioned ESG compliant commercial real estate. Is this, do you sense this is becoming a critical factor here in the developments of this market?
Yeah, in the discussion we have with issuers, lenders, and sponsors, it's really something, a topic, both in terms of the E to control the operating expenditure, but also to attract new tenants, to bring employees back to the office. And generally also we see more and more lenders adding to their financing conditions some ESG milestones in order to push borrowers to renovate their assets, to have some milestones about how they are going to complete this renovation and this move to more green assets. So it's clearly something we see in order to avoid to have some stranded assets with some residual value that are extremely penalized by non-ESG compliant credentials.
Yeah, absolutely. Okay, thanks. And staying with the ESG theme, let me come to you, This is quite a specific question. You showed that slide with the country differentiations, and I got a question: why is the transition risk for France much lower compared to Spain and Italy?
This slide, right?
Yeah.
Yeah, that's a good questions. I think there's a number of things at play. So the first is the fact that you have a difference, of course, between scenarios, and especially you see that the transition risk is not playing a role at all in the hothouse scenario, given that there is no climate action taken, and that it is indeed for France much lower than for Italy and for Spain. The reason is a bit that the French electricity system is rather CO2 neutral, given that they have a very large nuclear park and as such much less CO2 emissions compared to Italy and Spain in their electricity generation, which also pushes down the implied CO2 emissions in scope 2 then. So the emissions coming from your electricity use, which are for many companies the most important part of their emissions.
Okay, good. Thank you for that. And Stefano, on Italian NPLs, this is a question really about the sort of the age of the vintages. Why do younger transactions perform better than older ones?
Thank you, Keith. Well, I think that this question is related to this slide where we compare the actual gross and net cumulative collections with the business plan. Yeah, I said that usually the oldest transactions are performing worse than the newest one. This is mostly due to one factor, in the sense that usually at the beginning of the transaction life, there are a lot of collection that come from, for example, ad interim or cash in court or extrajudicial strategies. And since the business plans are crafted by servicer following a judicial strategy approach, this collection will create a sort of peak, positive peak at the beginning of the transaction's life for some metrics like the cumulative collection ratio. And then normally as the transactions age, we will have less collection from ad interim, from cash in court, and also DPO's collection will run out, so that we will see what we see is that the oldest transaction perform worse than the new one. And yeah.
Okay, excellent. Thank you for that. Gentlemen, I think we have run out of questions now, and so I suggest that at this point we close our session. So I'd like to thank everyone for their contributions today, and thank you to everyone who was tuned in to watch. Hope you found that useful. We will follow up with a similar session for Q3 at some point. And in association with this session, we also publish an activity report covering a lot of the same subjects as we have today. So you can see perhaps in more detail, and you can read some of the outputs when we publish the report. So as I said before, we will send you the slides for today's presentation after the session, along with the replay links for our recent webinars on Italian NPLs and on CRE. So thanks again. I wish you a very successful rest of the afternoon, and we will see you next time. So goodbye from us.
Thank you. Bye-bye.
Thank you, everyone.
Thank you.
Thank you.
Goodbye.
Bye-bye.